What was a mid-cap back in 2008 is a small cap now. I think about 3 brokers have sent 2025 the year of small caps. So the average small cap manager in Australia does add quite a bit of value, 2 to 3%. That's pretty material if you compound that. The maths is a pretty strong case for being an active manager in Australia. It was October 08 and we're sitting in breakfast and the CEO just said, oh guys, sorry, I've got to leave. You could feel the world, it was a pretty amazing time.
Hero or sidekick?
Welcome to Sidekick, the podcast where we uncover the hidden superpowers that drive some of the biggest and fastest growing companies and successful names in the business world. My name is Bryce and I'm joined by my regular co-host Ren, and we are your trusty sidekicks. Ren, how are you going?
I'm very good, very excited for this episode. We're up to episode 7 of our Sidekick podcast, and this is the first time we've got a fund manager joining us. So no pressure, but Andrew Smith from Perennial, welcome, and thanks for being our first fund manager.
Thank you very much, very honoured. And 7's my lucky number as well, so that's perfect.
Good.
There we go, things are looking up early. So for people who haven't heard of Perennial, can you give us, an introduction to Perennial and also your role of head of small caps?
Perennial Value, which is the part of the business I work for, it's been around since 2000. Started off as large cap equities, then when they wanted to grow the business into small caps, I joined in 2008. So I've been there a pretty long stint now and really just looking to find businesses that are undervalued, underappreciated by the market. So looking in parts of the market where no one else is to really find that value, and it's been a pretty fun ride over those almost 17 years now.
Joined in 2008. What was that like?
There were some pretty memorable site trips. I remember once, I think it was October 08, I was over in Perth and the iron ore ships got turned around from China. They wouldn't take delivery.
Oh, wow.
And we're sitting in breakfast and the CEO just said, oh guys, sorry, I've got to leave. You could feel the world, it was a pretty amazing time to be investing. But we're quite a conservative manager, value focused. So we held up much better than the market in that fall. And then we raced out of it because we were very active and focused on small caps. So very rewarding part of my career. But it's burnt into my memory that COVID sell off. And I guess you put that into your thinking when you're investing. COVID was the same sort of thing, fell less than the market and raced out of it, but they're pretty full on times when you're investing through it.
This podcast is all about unpacking the superpowers behind some of Australia's best investors and companies. Were there any real lessons that you learnt in that time that stick with you to today? Yeah,
I think the lessons are being really conservative around the balance sheet of the company because if the market shuts, which it can in the COVID or in the GFC in 2008. You need to have enough cash flow and not too much debt so you can ride through it. So that's obviously a big lesson, which is part of our process. But also I think backing yourself when you see tremendous value, the stock's getting sold off aggressive and you go, hang on, I've done all the work. I've met management, I've met competitors. We're just going to back ourselves and buy as much as the companies we can. And that's been our best returns. And if looking for our superpower, it's sort of backing our conviction and being patient for that to play out.
Love it.
Just like buying Afterpay at $9 during when was it, COVID?
Yeah, I'm not sure that was quite the value investment play.
We had many similar ones, but that wasn't. Afterpay sort of didn't meet our process. But there's lots of examples of buying great businesses at those key moments in markets.
Yeah.
So Andrew, can you give us a bit of insight just for those who are joining us for the very first time on what is small cap and micro relative to other parts of the market and then how that plays into the strategy?
It's actually a really good question because it has changed a lot since I started. So in 08, we would happily buy in our small cap fund, 100 million market cap, maybe up to $1 billion would be the sort of the big end of our small cap fund. Now the average small cap in the index is 1.4 billion.
Wow, the average.
The average. So that's been a huge change. So what was a mid-cap back in 2008 is a small cap now.
So this is Australian market.
This is Australian market.
Yeah. What would the cutoff be for small to
about
mid?
$3 billion now.
Yeah, right. Okay. Yeah.
And so as you go outside the ASX 300, which is the end of the small cap index, which is 100 to 300, you go about below 500 million market cap. And that's really what our definition of microcaps is now. Whereas when we started, we would have thought a microcap was a $50 million company.
Yeah.
So there's been quite a change in market and you've got to sort of change to reflect. So we launched our microcap fund in 2017 to really target that sub 500 million part of the market.
If I spent my life building a $400 million company and, I owned 25% of it still. I was worth $100 million. And people were telling me my company was still a microcap. I'd be offended.
I've had many conversations like that. You've got to be a bit sensitive with the founders and say, look, if you get into the small cap index, which is 600, that'll be a great achievement. They're like, I'm already worth 100.
You call me small?
But that's just the reality of how markets have changed. And US is similar, where the average market caps and liquidity, and everyone's pushing up the size factor.
Wow. Yeah. So in terms of the strategy in the small cap space, you mentioned value and you spoke about the importance of balance sheet and low debt. What are some other hallmarks of the strategy or the investment philosophy?
Yeah, so we're really looking for something that's underappreciated by the market. So we do a lot of work to try and uncover a part of the business or a part of the earnings power of the business which we think is underappreciated. And it's probably best through sort of examples to sort of flesh it out. But sometimes it's the asset base of the business is potentially not producing huge returns at the moment, but we think there might be something over time that'll drive that. So Superloop is a great example. I don't know if you've come across Superloop, which has been a really successful investment for us. Both our microcap and our small cap fund is now in the ASX 300, so it's gone through that journey. When we bought it, we thought we were getting assets, which was basically fibre optic cable in the ground, a network that was very valuable but only utilised about 15%. So our view was, if you double the utilisation, that's just cash is going to pour into the business because all the costs are sunk. We invested on that basis maybe 5-6 years ago off the top of my head, and that's exactly how it's played out. They've done some acquisitions. They've used that fibre optic asset, which was sunk and we could value, and the earnings have really poured through the business, which the market had missed back at 70 cents. Stock's close to $2 now.
Oh, great example.
Yeah, so they're the sort of things we look for where it's pretty apparent that there's an undervalued situation. There just might need to be a catalyst or patience to see it sort of play out.
Utilisation has doubled and it's now 30%. Could utilisation double again?
So they've actually gone well past 30% with acquisitions, and so the earnings power of the business has probably done better than we thought. Management's been fantastic, and there's been a bit of corporate interest you might have seen with Aussie Broadband at the beginning of the year. So it's actually played out better than we thought. But
nice.
that's what you get when you buy good management teams as well with underappreciated assets. You can actually, like Unity Wireless was another one which we actually backed pre-IPO, became Unity Group. It was down 25% on the day of the IPO, and we bought as much as we could to 15% of the company, and then made all the way to top 100.
Wow.
So I don't know if you remember that one, but Unity Group was another similar situation where you back a great management team with a good asset, you can really do well.
Nice.
So Andrew, the last few years have been pretty tough for small caps.
Sure has.
There's certainly a sense that they might be that might be changing now, which we'll get into in a little bit. But what sort of qualities do you have or strategies do you have that kind of help you through the challenging times where it can be year after year after year? What do you kind of keep in the back of your mind to get through those periods?
Yeah, so as I mentioned at the beginning, having that conviction, you've really got to have the conviction in the underlying businesses, because you do need patience. So if you don't know your businesses that well and they're just stocks going up and down every day, you're going to lose patience before you've actually had your chance to make money. So having patience from our point of view, but also having patient client base is hugely important. So we've got a very diverse client base, and the biggest clients have been really patient. We made a lot of money in the past, and they know that when small caps start to turn, which maybe 2025 is the year, that you can make a lot of money in that sort of 3-4 year recovery phase, which we've done 2 times before. But you've got to be patient, and you've got to be set ahead of it. Because if you're a big institutional fund, like we manage money for a big offshore government entity, they have to move a lot of money. So they've got to get set ahead of that. And, big high net worth investors are the same. If you want to put $10 million into a microcap fund, you don't want to do that when it's up 50%.
Yeah.
You've got to get in now to be able to spend it.
Yeah. So 2022 and 2023 were tough years for small caps. And then 2024, there was a little bit of optimism. We pulled some quote here from JP Morgan in sort of mid-2024. They were calling 2024 the year of the small cap bounce back.
Yep.
Do you think we saw that? And is 2025 going to be the year where it really comes hard?
Yeah, I think you saw a hint of what was to come. So up till September, in the Aussie context, you had sort of double-digit, sort of even over 20% type returns starting to come out. Our strategy was the same. Then you had a tougher December quarter, a bit of uncertainty, Trump coming in and sort of certain parts of the market doing really well, others being left behind. But I think it did give you a hint of the potential power, how quickly things can move. This year started with, I think about 3 brokers have sent 2025 the year of small caps. So I think they were just a bit. It's you've seen a hint of it, but it's a 3-4 year recovery phase. So. That's what's worth hanging around for, not just the first little blip, which is what we've seen.
And for those that have seen the headlines, of the last 12 months of everything ripping in the States from a tech point of view and just, market euphoria, help us understand why there is that divergence between the small cap end of the market and then the large cap over the last few years.
Yeah, I think there's obviously quite a strong momentum trade in the market where, valuation isn't an anchor. The Magnificent Seven, for example, people get a bit of FOMO and they chase it, and small caps just hasn't had that. You haven't had anything to chase. We're starting to see a little bit of that, the Russell, which we spoke about, the small cap index in the US starting to move. That's starting to get talked about. You can feel the sort of early snowball effect. You really need that to get the investor flows in. So the best thing to learn in economics is supply and demand. If you've got, a set supply, the amount of stocks out there, but you're suddenly having a few people, more and more people wanting to come into the space, that can really drive up the price. We've had the opposite in Australia. We've had institutional funds pulling out. So the supplies come out. Demand's come out of the market. Price has gone down. We need to see institutional funds coming back in, high net worth funds coming back into small and micro caps. Similar in the US. We're seeing in the US early signs. Very early green shoots in Australia. We're having a lot of conversations with clients now that want to come back into the space after not being there for 3 years. That's what you need to see. It's pretty simple.
Yeah.
But more buyers, the same amount of sellers, the price goes up.
Yeah.
Now, the clients that you're speaking to might be a little bit bigger than a number of listeners to this podcast and the Equity Mates podcast, but we're certainly seeing the same theme emerge. A lot of conversation in the Equity Mates Facebook discussion group around small caps and how should we be investing in this, because I think people are reading the same things, and seeing the same things that you're seeing, and it's they want to get set.
Yeah.
And the big question that we see is always passive v active.
Yes.
The choices around passive ETFs, small cap ETFs, there's so many, and more we're seeing active fund managers bring products to market to the ASX and the like, or lowering their minimums. So we've really got that choice.
Yes.
So you've obviously got a dog in this fight. You're an active manager, but make the case that how we should think about small caps, investing in small caps.
Yes, I think the case is probably less clear when you look at the US in terms of the average outperformance of the small cap manager there is not super convincing. It's a much bigger market, and the average market cap's much higher. But if you go to Australian and look at the Australian surveys, the average small cap manager in Australia does add quite a bit of value. 2 to 3% is sort of an average. That's pretty material if you compound that. If you have a look on our website and look at our commentary, the compound effect of we've done, I think, 2.7% alpha after fees on top of the index. That's a huge difference over 10 years.
Yeah.
So the maths is a pretty strong case for being an active manager in Australia. Access to it, I get what you're saying, but through your super fund, we can take retail investors. I think there is enough access to retail funds for the average investor where it's worth going that extra effort to fill out a form, to get an extra 2.7% a year on top of what could be a 10%, getting 12.7 instead of 10. That compounds pretty nicely over time. So I think the maths is pretty compelling in Australia.
Well, here's
for small caps.
Here's some maths that we did for a recent episode that I'm going to try and remember off the top of my head. So just fact check these numbers, but they're broadly right. We got a question. Someone had $5,000 lump sum and then was planning to invest $200 a week, and that we looked at what it would return if they got 10% a year or 13% a year over 30 years. And it was 10% in that time frame was 1.4 million, and then 13% was 2.7 million. So it's the effects of compounding really start to make a difference over the long term.
It does. And so I think that the maths is pretty compelling on being an active manager. And versus, I guess the other one is going direct yourself. And it's obviously lots of fun being a direct small cap investor. But all my money's through the fund as well.
Yeah.
We don't do any direct investing. We don't want that conflict. And also I'd rather have it diversified. I think it's tough if you're trying to pick the best 5 small caps yourself. I work pretty long hours. All I do is small caps, and we don't always get it right either. So I think there's a pretty strong, compelling case for funds. It's just been there's better returns in crypto and other things last year. People just probably have to think, well, I want to invest in the underappreciated asset, the one that hasn't moved yet, and that would be small caps.
Yeah.
And when
that's part of the case.
When it comes to picking an active manager, is it just historical returns that we should be using as a barometer of success? Or
well, there's a disclaimer that's on all of our reports that past performance is not an indicator of future performance, and I actually think it is actually really relevant to think about. Whenever I've bought a fund, so when I go offshore to look for investments, I just do it through funds as well, or an ETF on the index, for example, if there's no active management premium. And I'll probably buy the out of favour manager that's produced returns in the past, but maybe the cycle hasn't been in their favour. And then when that happens, you can get sort of a double whammy of a catch-up in their performance on top of a catching-up market. So, but I'm contrarian by nature.
I was going to say, it kind of feeds into your strategy.
Yeah, and we don't chase momentum, so that's kind of my psychology.
Yeah.
Yep.
Yeah.
Interesting.
Now, one other thing that Perennial does is get quite active when you see that there's see that something can be improved.
Yep.
You'll engage with the companies. There's been instances before where you've pushed board members to better represent your interest, recommend debt advisors, bring in co-investors. So talk to us a little bit about like the activist side of your strategy, and maybe if you've got an example where that's led to a good outcome.
No, it's good that you've picked up on that. So we call it active engagement rather than activists. So we want to work with the company to get a better outcome. Unfortunately, that might mean a few board members have to change along the way, or maybe one or two management. But we want to get the company into a better position so that it gets rewarded on the market. So if I take Superloop as an example, we took an asset, a potential buyer of one of the assets to them. It was the Hong Kong, Singapore assets. They weren't getting valued, and we didn't think they were going to be a part of the story going forward. So we found a buyer, took it to them. That started a process. They actually got a better price from someone else.
Oh, nice.
So that was a great outcome. That was cash on balance sheet at a time when the market was selling off. So that was handy. Other times we've just looked to really improve the quality of the board to sort of help, improve governance, but also help the company in a network sense, or bring in co-investors that we think are more patient investors that we want alongside us. It's a big part of our strategy, and probably something, if I think about what's changed, our process hasn't changed from what we look for from a cash flow and debt and growth. We're much more emphasis on how can we help the company from an engagement point of view, whether those examples you gave is the tools we have.
Andrew, we're just going to pause here to hear a message from Superhero. This podcast is brought to you by Superhero. Are you looking for a way to level up your investments in 2025? With Superhero, you can invest in Aussie and US shares and earn Qantas points when you trade.
That's right, you can invest and be rewarded with Superhero. And to kick off the new year, Superhero is giving you a chance to win a share of 5 million Qantas points, with weekly prize winners drawn until the 10th of March.
So what are you waiting for? Link your Qantas frequent flyer account and start investing with Superhero and go in the draw to win today.
Offer ends 8th of March. T's and C's apply. Authorised under New South Wales NTP 12120, ACT TP 250024 and SA licence number T2514.
Welcome back to Sidekick. We are here with Andrew Smith, Head of Small Companies and Microcaps at Perennial. Andrew, we want to now turn to unpacking your experience as a portfolio manager for those that are kind of interested in getting into the profession. So how did you become a portfolio manager? What was the journey?
Yeah, it's a great question, and it's actually hard to get in. So hopefully, people just don't give up and they just keep chipping away. So when I was at university, I actually thought I wanted to be an investment banker. Thank God I didn't do that.
Yes, yeah.
But I was going to graduate in the .com crash.
Oh, wow.
Which is 2000 for all those young listeners out there that didn't live through that. And there was no one hiring. So I did another year of university to try and differentiate, so an honours year in finance. That helped a lot in terms of you go right up to the top of the stack. So you got to stand out from the thousands of people doing the same commerce degree, basically. So whether that's adding law or doing honours or something like that, I'd encourage that. But getting work experience is the main one. So then I got a job actually working for a large cap value fund that's still around, Tyndall. That was a great experience. I was on the graduate program though, so the bit I loved was the asset management bit, but I had to go and do tax, accounting, marketing. You get rotated through. And I worked out pretty quickly that I loved the investing side, the analytical side. And so then just kept looking until I found a way to make that my full-time job. And that was actually going into stockbroking as a research analyst. And that exposed me to, it was an institutional-only broker at the time, since got bought out by ANZ. But all I was doing every day was researching stocks and talking to fund managers. And so working in a broker is a great way to get access to the eventual employer. Perennial was one of them. And then, 5 years after doing that, got hired by Perennial to do small caps.
So you've worked in the finance industry for over 20 years now. You would have seen some of the best investors. You would have worked with some of the best investors. You yourself are a pretty great investor. What are some of the traits that you see over and over again in the best investors?
It's interesting. I was talking to a client about this just yesterday, and he just met with a very impressive fund manager in Australia. I won't name him to embarrass him, but I think it's work ethic. So all the really good managers, they've all got that common trait. They might have different styles, but they all work. It's not a 8-hour-a-day job. It's a 14, 15-hour-a-day job, and it's probably a day on the weekend as well. And you have to love what you're doing to be able to do that. So I think that's the number one thing, and then have a process and be disciplined around that process and stick to it. That's really important, so don't get caught up in fads in the market and go away from what you're good at. Also working out what you're good at. So I'm not a good momentum investor. I'm a good value investor. So I didn't make any money on Afterpay, for example. But we made plenty of money in other ways. So you should know what you're good at and stick to that.
So when you talk about process, I think a lot of people think about the sort of conflate that with like investment criteria or an investment philosophy. But when you're talking about process, do you also mean like the inputs, like how you manage information and how you take it in? Can you just talk to what your input process is there?
Yeah, so we're very heavy on modelling the company from a ground up ourselves, so not relying on broker forecasts. And I guess most of my team have at some point been a broker research analyst like myself. So we kind of know all the pressures they have and the corners they have to cut. So we want to do it ourselves. So you want to understand the business. By doing that, sounds boring, but putting all that information in a spreadsheet, modelling the history, you actually understand the business much better. From that, then you go and interview management, interview competitors, gather as much information you can about what are the drivers going to be of the business, and then put it into your process once you've only done all that research. And the process says, if the company's at a decent discount to the market from a valuation point of view, but it's growing faster and it's got less debt, it's eligible to buy for our fund. But the real work is before that. Yeah. Getting comfortable with the earnings forecast and the potential earnings of the business. Yeah.
And how often are you like stepping back and saying, is this the best process that we can be doing? Is this giving us the maximum outcome? Can we keep sort of improving on this?
Yeah, so we sort of do a formal review annually, and that'll be tweaking things like over the years we tweaked the screening at the beginning to make sure we might have felt like we've missed a few things, and one thing we were missing is maybe could we be earlier and pick up companies a year away from being cash positive, and we've actually made some good money getting in ahead of the market a bit earlier when we're really confident that next year's going to be great cash flow. So getting in probably a year ahead of our competitors. So that was one thing that came out of the process. And then that engagement piece I spoke about. We'd seen that our best examples were one where we'd helped the company, added board members. So I think we've had 17 directors now go on to boards on our recommendation. And these are just good independent directors we think will add value. So we've really ramped that up as part of it. So formally, annually, and then you look back at, there's a lot of data in funds management, so you can look back and, one thing more recently is, I mentioned we're not good momentum investors, but once we've got something right, ensuring we don't sell it too early because the market tends to snowball as it discovers things, and my tendency is to, once it's discovered, okay, I'm bored now, sell, go buy something that's undiscovered, but you can miss a 30% on the table re-rate from something you know very well that's gone to fair value but it's not expensive. So let's let it go to expensive before we sell it. That's been a more recent. There's actually a client of ours shared that data with us, which was pretty compelling.
It's one of the more common questions we get, and we've interviewed hundreds of fund managers now on Equity Mates, and everyone has a spiel for how they buy. Like, it's the bread and butter of the finance media industry. Every fund manager who's coming on shows knows, their philosophy and some examples and how to buy. But that question of how to sell is the hardest question, I think, in funds management.
And it's asymmetric. It shouldn't be. It should be symmetric. Like you should put just as much thought into selling as buying. And that's sort of the thinking we've had recently in trying to put a bit more emphasis on the selling decision.
So you said there, you now, if a company has that momentum, you want to let it get past fair value.
Yeah.
A company can get well past fair value, and I'm sure there'd be nothing worse than you thinking it's past fair value, selling it, and then seeing it double from there. So it
depends on what we put the money into.
True. Yeah. But what are some of those indicators that it's like, okay, now is the time to get out?
Yeah, I think when obviously we've got a spreadsheet telling us it's now a little bit expensive, but it's when we track what all our competitors are talking about in their top 10, and when we see it like in everyone's top 10, you're like, okay, who's left to buy it?
Yeah.
When you see it on Reddit forums with
when you hear it on equity
and it's gone into the index, so there's no passive buying left. Then you go, okay, the best returns might have happened, but that, as you say, things can still double and triple if they get really euphoric. Like I would have sold WiseTech years and years and years ago, and it still keeps going on. Tech One's one we did sell years and years ago. But they've gone from highly valued to like extremely highly valued, and you just don't know when that bubble's going to burst. So we're happy to be out and miss that. That's not our style. Yeah. But just getting that last sort of 30% out is pretty important when you've done all that work for 4 or 5 years. So that's something we're trying to improve on.
What about on the flip side? Like, what about if you think you're right about something, but the market is just not agreeing with you, and it's in your mind it's staying cheap, but there's an opportunity cost to stay in a position that's not growing. When do you cut your losses and sell on a stock that hasn't grown?
Yeah, so we won't cut our losses if the investment thesis is still intact, and it's just being ignored. We will be patient because we've seen how quickly it can go from being ignored to being the flavour of the month. It can literally be a matter of months. So you could have waited 4 years, but you get all the return in 2 months.
Yeah.
We will cut if the investment thesis changes. So we've had examples where we don't get engagement with the board. They want to go down a different strategy. They don't want to listen to our thoughts and insights. We'll just cut. Even if we're losing money on the trade, we're like, well, we don't have engagement with the company, we don't have alignment. We'll cut, or there's big director selling, or there's a management change we weren't happy with. They're the more sell decisions, rather than, okay, it hasn't been re-rated yet. We'll work harder to try and help it get noticed by the market. So we'll come on Equity Mates and talk about it and things like that. But we're not going to cut something just because the market hasn't noticed it. If the business is performing, we'll hold. And we've had stocks we've held for sort of 10 plus years.
Wow.
That are performing now, but there was probably 4 or 5 years where they weren't doing much.
Yeah.
Wow. Yeah. So Andrew, we've covered a lot of ground, a lot around the superpowers that are involved in becoming a good portfolio manager, as well as unpacking hidden gems in the small cap space. For those like Ren and I who are wanting to become better investors, how would you kind of sum it all up? What superpowers should we be thinking about? So
I think you've really got to, as I touched on, it's really hard work and the hours you put in, but to do that, you've got to be passionate. So first of all, work out if you're passionate about investing in small caps. If you are, read as much as you can, listen to as much as you can, digest as many as annual reports, and investor newsletters. Like I read a lot of competitors' offshore investor newsletters. It's a great way to absorb how they're thinking. I mean, nearly every Warren Buffett book I've read, and lots of others. Just absorb as much as you can. And use as many hours as the day as you can looking at investing.
Nice. Now, it would be a miss from us if we closed without getting a stock tip. So what is front of mind for you at the moment? What's exciting you?
Yeah, so one that's exciting us but is not exciting the market, which makes me more excited, given I'm contrarian, is probably Sidev.
Sidev.
Stock code SDV. Okay. So it's in our microcap fund, in our top 5. Why I really like this is it's gone through that management change where we've now got a CEO who's very aligned. He sold his business in. What they do is it's specialty chemical solutions for the mining and water industries is a simplistic way of saying it. But the key drivers for the business, have you read all about the PFAS contamination of Sydney drinking water, but it's a global problem. There's been lawsuits in the US. Sidev has got the most revenue we've found in Australia from treating PFAS. So they remediate PFAS problems. Okay. Cleanaway, one of a top 100 company that's ever awarded 2 or 3 contracts to Sidev. So that shows you that the biggest waste company in Australia is using Sidev to remediate. We think they can take that technology offshore, and they've just won something in Sweden. If you read the annual report closely, there's some reference to the Department of Defence in the US. They're in the part of a tender program, which is public information. Yeah. So we think that's really interesting, taking Aussie technology that's clearly working and take it offshore. But it's a profitable company. From memory, made about 8 million EBITDA last year, growing fast, has cash on the balance sheet. But that's just one part of the business. The other part has got a bit more exciting with Trump coming in, and that's they sell specialty chemicals to the oil and gas space, particularly the US market. So Trump wants drill, baby, drill. That demand is only going to help Sidev sell more chemicals into the US shale oil market. And you contrast that with they've won the Swedish PFAS work. Trump's come into power and the stock's come from its highs of 60 down to maybe even 38 today. And that doesn't really make much sense given, the two parts of the business have got huge tailwinds. So we're in there buying more of that at the moment.
Awesome. Love it.
Love that. Well, that's the one thing I love. Well, there's a number of things I love about speaking to managers, but speaking to small cap managers, it's just these companies that I'd never heard of before who are doing really interesting things. Who knew that I would leave this room and start researching wastewater and specialty chemicals?
Yep.
But Andrew, that's the effect you have on us. So thanks for jumping in the studio and joining us on Sidekick today.
No worries, and good to see you again.
Yeah, likewise.
Cheers.
And if you're interested to learn more about how to grow your wealth like a superhero, head to superhero.com.au/registration.
Subscribe to Sidekick wherever you are listening so you never miss an episode. That's it from us, your trusty sidekicks. We'll be back uncovering more superpowers next episode.